Mahesh Nandurkar joins us. It's pointless to talk about valuations, flows, technicals, global cues, because when you are pitted against the election cycle, it is the election cycle which matters in terms of the near-term positioning. So Mahesh, is there merit in discussing flows, technicals or valuations at a time when we are pitted against the election cycle?
I think elections, something that we have been going through, and the results will be out on the 4th of June. So, what you're talking about is something that will probably impact the market over the next 1 month or so. But probably beyond that, all the factors that you mentioned, the valuation, the flows, and all that will become relevant once again.
So, what to your mind, from an election standpoint, is in the price, and what do you think markets are not prepared for?
Yeah, I think that's that's a tough one because the market has actually become much bigger in terms of different participants and foreign investors, domestic institutions, and also now retail. The domestic retail has also become a substantially large part of the market, and what's in the minds of Indian retail investors also determines what's there in the price. So I would say a difficult one to guess at this point in time as to what exactly is factored in. But I would say that if you look at the analysis of the retail flows over the last 1 or 2 years, and especially in the last 3-4 months, what you notice is that a substantial jump in the net retail buying at the single stock level. We've always known the story about the mutual fund flows and the SIP and all that for a long time. But what we have seen in the previous 4 months or this calendar year is almost $8 billion worth of net buying by the Indian retail households in the direct stock market. That's a very big number. That number almost rivals, the SIPs, actually. And my sense is that, if you compare that number with the calendar year 2023, where the retail single stock purchases were actually quite muted, just about $500-600 million. So full year number is $600 million, 4 month number $8 billion, and that clearly tells you that the retail investors' psychology thinking has changed substantially in the current calendar year as compared to the last year, and it could be, I'm not saying that is the reason, but it could be because of the expected, strong performance, or the strong outcome at the elections. And, so from that perspective, there are substantially elevated expectations from the Indian retail investors. That's for sure, according to me.
Mahesh, one understands what's happening with the retail participation in the market. But what about FIIs? They continue to, almost see a mass exodus. And from what we understand, it's not as simple as money moving out of India and moving to China because of their valuations being cheap. It's altogether moving out of emerging markets, is what our intelligence tells us.
Yeah, both. Both actually at this point in time. The China factor wasn't really that prevalent until, say, over the last 15, 20 days or last 1 month. But the broader emerging market outflows has been a story for the last 1.5 years, 2 years, actually, I would say. And the big trigger point on the positive side on that front would have been the expectations around the Fed rate cuts. But as we know, the US economic data points have been quite strong, and the Fed rate cut expectation is getting pushed out. Now, I think the consensus is expecting maybe just one rate cut in the last quarter of the current calendar year. That's what it looks like, or maybe like 1.5 rate cuts or something like that. So I think for the broader emerging market flows to improve, we do need to see, or we do need to get some visibility on the rate cut cycle, from the US Fed. So I think that continues to get pushed out, and that's, I think, one of the primary reasons why we are seeing large outflows from the broader emerging market universe. But more recently, we have also started to see the China factor beginning to play out as well. There has been some improvement in the China PMI, the global PMIs, and by and large, the valuation story about the Chinese market was well known. But that seems to be drawing some some pool of global monies or emerging market monies at this point in time. But I think that there is a very wide acceptance that India is the structural story. That's where the visibility on growth, etc., is clearly there. But I think the foreign investors are also worried a bit on the valuation differentials. So yeah, but I think, to my mind, probably things could remain a bit volatile, say, over the next 1 to 2 months or so. But if I look at a 12-month view, then the market looks pretty solid, and I still continue to like the CAPEX story, the infrastructure, the manufacturing, the real estate, those kind of sectors should continue to do well with a 12-month view. Maybe from a near-term perspective, there could be some volatility.
When you say 12-month view, why do you like from a 12th? Why do you like them from a 12th month view? Do you see a series of events which could happen in next 8 to 12 months which could re-rate these stocks?
Yeah, I think the stocks have got re-rated, but what the key point that I'm making, and I have been making, is our conviction on the broader CAPEX cycle. We've clearly seen housing cycle turning around. We have seen a turnaround on the private CAPEX cycle as well. Although I know that some people still question that, but the data that we're looking at clearly shows that there has been a turnaround on the private CAPEX cycle as well. So I'm a firm believer in that we are in a multi-year CAPEX upcycle. And if you look at the earnings growth, and not just the growth, but even the earnings expectations for many of these CAPEX-related stocks those have been going up. So while the broader market might be seeing small earnings revisions on the downside, several of these CAPEX-oriented stocks are actually seeing earnings upgrades and very strong earnings growth. So we don't even need the stocks to re-rate. Even if they're able to maintain the current multiples, you can easily get a 20% plus return in many of these stocks and sectors.
Mahesh, morning. Given that you were alluding to the overall China factor, just wanted to understand particularly sectors that are closely linked to this or that could suffer on account of China gaining more ground. Do you see that sort of happening?
I think China gaining more ground, I don't think the sectors, will suffer, because fundamentally speaking, from the bottom-up economic perspective, we don't really have too much of economic dependence as such. In fact, I would say on the positive side, from the investor sentiment point of view, some of the global cyclicals like the metals, the commodities, the refiners, the petrochemicals can actually see a positive, impact, because those are the ways in which an India dedicated fund can sort of look to play the global cycle or the China cycle, as such. So yeah, it could be a small term negative from the flows perspective, but I clearly believe that the bigger part of the foreign flows is actually the global and the developed world money coming into the emerging markets, and not so much the emerging market funds, making India underweight or increasing China overweight. And those are small changes. Those don't really, move the needle that much. What really moves the needle is, the money coming into the broader emerging market as an asset class. And as I said, that seems to be getting pushed out a little bit for now because of the rate cuts expectation in the US that are getting pushed out.
Mahesh, if one assumes that FIs will continue to sell, nobody knows, but let's assume if this feature continues, then in the near term, do you think that could be an overhang for, let's say, FMCG, banks, IT, because these sectors are suffering because of technical factors?
Yeah, so as I said, I don't know what you mean by near term and long term, but if I take near term as like 1 to 2 months perspective, I would say that many of these sectors like even FMCG, or IT or pharma, which are the defensive sectors, these are under-owned sectors, both by foreigners as well as the domestic investors. So if I take a near term, meaning next 1 to 2 month perspective, I believe that some of these sectors can actually do better. And that's what we've recently done. We've actually recently raised weight on the FMCG sector, more from a tactical and from a near-term perspective, because as I mentioned to you earlier, our longer-term thesis still continues to stay positive on the CAPEX story. And from a 12-month perspective, I still like the infrastructure, the industrial, the real estate, kind of names. But from a near-term and from a tactical standpoint, I would say playing the defensive story through consumer and FMCG actually makes sense.
Mahesh, are you still overweight financials and, including private banks? Because they are the ones which have really underperformed, but still conviction is pretty high on the street.
Yeah, that's true. I think, so I think for the private banks to actually start performing in a meaningful way, we believe that there would need to be strong foreign flows, which seem to be being evasive at this point in time. And I do see, the risk reward actually tilting in favor of the state-owned banks. It's been happening for some time. It's not just now. It's been there, for some time. And I think, that will probably still continue because, of the two factors. I mean, we have seen some credit growth slowdown driven earnings cuts for private banks. We've seen some of that happening in the December quarter, in the March quarter results as well. And probably it will continue for the next couple of quarters as well, as the high loan to deposit ratio is weighing on the credit growth for some of the private banks. Whereas there is no such issue with the state-owned banks. And on the other hand, I would say that with our expectation of a strong CAPEX cycle, which is actually a great news for the NPLs or from the credit cost perspective, and I believe that you might actually see some positive surprises coming on the credit cost side and on the NPL side over the next not just few quarters, but actually a few years, which could be an incremental positive for state-owned banks.
Mahesh, the surprise factor for me at least has been this marked recovery in rural India, whether it is FMCG or two-wheelers. Where is this coming from? I mean, this has really surprised everybody.
See, if you look at the data points, the data points that support a strong rural recovery are visible or have been visible, only by way of the two-wheeler demand, which has been, reasonably strong now for the last 6 to 12 months, actually. But barring that, we haven't really seen, too much of data points supporting, a strong rural recovery as such. I know that the stocks have recovered on expectation, and as I mentioned, in fact, we've also raised weight on FMCG. But I would, not attribute too much of that or too much of those stock price performances on the rural recovery as such. That there is probably a mild recovery, at this point in time is, what I would say. We're looking at some of the data points like the Rural Employment Guarantee Scheme and the number of jobs demanded under that. So that is showing now a decline, which implies a rural recovery as such, because not so many people require jobs under that scheme anymore. So that's a good news. But if you look at the consumer staples companies and their volume growth numbers, even as late as the March quarter numbers, not really seeing too much of an excitement there. I mean, many companies still reporting low single-digit volume growth. So yes, there is an expectation, but barring the two-wheeler demand numbers, barring the NREGS numbers, not really seeing much of evidence of that at this point in time. So I would actually not necessarily link the FMCG stocks going up to a big improvement in the rural demand recovery as such.
Do you see the urban end of the market also making a comeback? If I just look at, let's say, some of the consumer discretionary stocks, Vedant Fashions, or I'm just using that as an example here for the benefit of our viewers, or for that matter, VIP, or for that matter, even campus shoes. These were the go-to stocks in 2022 and 2023. They've corrected 20-30%. Is there a good trade coming in that end of the market also, discretionary spends?
Yeah, so I think, within the broader consumer space, we definitely like discretionary much more, than the staples from a 12 to 24 month view, for sure. And, I think it's a matter of time before the discretionary demand, shows up in some of the categories, which you mentioned. So yeah, so I would definitely say that some of those names look, pretty interesting. Autos actually, still continue to look quite interesting to us. Especially the four-wheeler names and some select two-wheeler names as well. So yeah, so from a longer-term perspective, discretionary definitely much, much better than staples.
Okay. Mahesh, where do you think a large part of the re-rating is still not discovered by the market? You know, CAPEX, infrastructure, railways, defense, some of these are good themes. They are great secular stories to be in, but their P expansion is unlikely. Re-rating in terms of perception, opinion and participation is unlikely to happen. Is there any end of the market where you see that, look, there is a story in terms of earnings and there's a re-rating potential in terms of perception?
Yeah. So the thing is, see, when Nifty as a whole is sitting at 21, 22 times, you're not going to see many stocks which you can classify as, value buy ideas. But I would still say that some of the stocks on the state-owned side, the PSU side, actually still look pretty interesting on valuations. I believe that many of the PSUs have not seen their historical multiples coming up, just as yet. And sort of many of the PSUs, whether it is oil, whether it is, coal mining, side, etc., are actually looking, reasonably depressed in terms of valuations according to us. So maybe that is one segment. I would also say the PSU banks as well, to just extend on that PSU side. So I think that is the only segment I would say at this point in time where the valuations appear to be, relatively, undemanding. Also, I would say the valuation story, is looking interesting for the private banks also. So yeah, so I would say the banking side and the PSU are the two areas where the valuations are still looking, quite reasonable and quite interesting. Um, yeah, but out of those, PSUs appear more exciting in terms of the earnings growth outlook perspective.
So Mahesh, if one is looking at, let's say, investing at the current levels with a 3-year time view, what do you think could be the return potential? If one assumes that inflation will remain flat, interest rates could move in a 1 to 2% band, globally we may not see too much of spike in the interest rates. If all the factors are constant, do you think from May 2024 to, let's say, May 2027, we could be in for a double-digit CAGR return even from these levels?
Yeah, I think so. So at a broader market level, yes, and specifically some of the sectors which will do actually much better than low double-digit returns. Would be, as I said, we still like sectors like real estate, the plays on the housing, as a theme. We still like infrastructure, capital goods, industrial, power utilities. So those are still the sectors, and I know that you mentioned that these sectors have got re-rated, and and I completely agree with you on that. But just look at the earnings growth. I believe that many stocks in this or many companies in this sector will drive earnings growth in the range of 20 to 30%. And I think the multiples can easily sustain at the current levels. Given the fact that we're clearly seeing the cycle playing out in favor of investment cycle. We are clearly seeing that a lot of large foreign investors are still not well positioned or positioned at all in certain cases, in these sectors. So I do see a strong potential that if the multiples, remain where they are, and which I think they would, the returns would be in line with earnings growth, which would be in excess of 20% for many of these stocks. So I would still, say their power utilities, real estate, sort of cap goods, infra look like the best sectors to own from a 3-year perspective. Also, a lot of uh, uh, stocks on the financial side, especially some of the the new sort of financials. What I mean by new is essentially on the non-lending side, which include your capital market related stories, some of the life insurance related stories as well. And maybe, yeah, just to repeat, I would still say some of the state-owned companies, PSUs and PSU banks. So that can be, still a good portfolio from a 3-year perspective.
Mahesh, that's on the positive end, right? But if I look at your model portfolio and the underweight sectors, I mean, I understand IT and the others. What stands out really is that you're underweight energy, and that includes names like Reliance and ONGC. Why is that?
So as I mentioned, in general, I'm much more positive and much more bullish on the domestic economic growth. So most of the stocks and the sectors that we are overweight on, are geared towards the domestic side of the story, because I genuinely believe that over the next 3 to 5 years and maybe even longer, India's growth outlook is looking far better than the rest of the world. And I think the foreign investors haven't really positioned, and I know that the foreign flows are not really looking good at this point in time. But at some point in time, and since we're talking about a slightly longer term thesis here, the rate cuts will happen, in the US, and the money flow will come into the emerging markets, and India will get its fair share. And the domestic flows, yes, I mean, we have seen, some element of probably, non-predictable flows in the recent past. And which is what I mentioned, that the $8 billion buying by the retail, in the single stocks in the last 4 months, that's a huge number. But, barring that, the long-term story on the domestic side, still continues to, sort of hold up quite nicely in terms of domestic flows, I mean. So both the domestic economic growth and the flows angle, makes me believe that it makes sense to be overweight on the domestic plays, the economic, the cyclical sort of sectors, by being underweight on some of the global facing sectors.
Mahesh, it's been a pleasure interacting with you. Appreciate you taking the time out and joining in with your overall assessment of the fund flows, the elections, as well as sectoral preference.
If you like this video, then like, share and subscribe to ET Now.